Hi, welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is Matt Darling, employment policy fellow at the Niskanen Center. Previously, Matt was vice president at Ideas 42, a behavioral economics consultancy. There, he managed projects on economic justice, climate change, and domestic healthcare. He also was strategic lead on labor and workforce development projects. Matt has a master's degree in economics from Tufts University and a bachelor's degree in cognitive science and economics from Hampshire College. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event is being recorded and will be posted online at TPC's website. We're using captioning, which you can adjust or turn off with the live transcript button at the bottom of the Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Matt Darling, welcome to The Prescription.
Hi, Howard. Thanks so much for having me.
Great to see you. So let's start by talking about today's labor market. At the moment, at least, it seems like we're in a fascinating place. Let's throw out some numbers. There are 3.9 million fewer jobs than before the pandemic, and there are 2.4 million fewer people in the workforce. The unemployment rate fell to 4.2% in November, but the economy added only about 210,000 jobs. Claims for unemployment benefits are lower than before the pandemic, and the quit rate remains high. So connect the dots for me. What does this picture look like to you?
Yeah. So I think, one thing that's happening right now is there's lots of different stories you can tell. And so, you can have different sort of angles on it. I think, the first thing to mention is that, we are seeing really rapid growth in the last year, right? Since the pandemic, or we're still, of course, in the pandemic, but since the sort of the worst part of it, like things have moved up really quickly overall. Obviously, any month-to-month labor market reports might be good, might be bad, but we're still seeing pretty rapid movement. The way I try to sort of look at this is compare it to how fast the economy moved out of the financial crisis in 2008. And we're basically responding at about 8 times the speed. So it's sort of much, much faster. And a lot of that is due to, just the overwhelming support from monetary policy, from fiscal policy, from all sorts of things that we put out there during the pandemic. Now, that said, I think you can go too far with that, right? And say oh yes, everything's great, the economy is booming, because as I just mentioned, the pandemic is still here, and this is still making things hard, right? And so I think right now you're seeing, some things that look like very, very tight labor markets, right? So unemployment rate, like you mentioned, is at 4.2%. Labor participation for prime age people between 25 and 55, about almost back where it was pre-pandemic, around where it was in 2018, not quite to 2019 yet. At the same time, there's a whole bunch of people who have left the workforce who are actually older, right? So people who are 55 and up, you see a lot of them have left, and it's right now there hasn't been any signs that they're coming back. That doesn't mean that that's going to be the case over the long term, but it does mean that they might be just responding to things like COVID pressure. Just like you don't want to go to work if you're someone who's at higher risk of transmitting or receiving COVID. And then the second thing that I think is really important to think about is how jobs have changed during the pandemic. A lot of, like I was saying earlier, if you're older, maybe you're at high risk, but also lots of other jobs are at high risk. So, we see big changes in things like food and retail outlets, and that's both, an area of low wages generally, but also a place that it makes sense that there'd be higher transmission rates. And so you expect to see people being like, well, if you're ambivalent between working retail and working, in data entry pre-pandemic, you're no longer going to be ambivalent between those two now. And so I think a lot of, job conditions in a lot of industries have gotten worse, and that's a negative story. And so it's really hard, and I think, but really important to try and keep both the really positive story, fast growth, things moving well, things moving much better than we expected, with the negative story of we're still in the pandemic, there's still a lot of problems to solve.
So I want to unpack a lot of what you talked about for the next few minutes, but let me start with the Great Resignation. So now that this has become a cliche, has it peaked?
That's a good question. I mean, so the data that people look on this is you can see quits, right? You can see what percent of people quit their job every month. And it's been hovering around 3% for the last few months, which is very, very high, very like unusually high. We don't see that unless the labor market's really, really tight on normal conditions. The last report on that, it went down a little bit to 2.7, which is, I think, not, lower, but still relatively high. So I think, if conditions sort of continue as they are, like I'm not expecting to see that drop drastically anytime soon. I think there is, the way that I've been trying to describe this is right now it is to some extent a workers' market, right? That workers have a lot of choice and a lot of opportunity. They can use that to, bargain wages up. They can use that to, try to influence work conditions. At the same time, COVID is holding a lot of those things back, no matter what the change in relative power is.
So playing against type for an economist, you're extremely optimistic about the current state of affairs. I want to just quote you in a recent blog you wrote. We're not struggling with the supply of goods and labor because we're entering an age of scarcity. Rather, crowded ports and for hire signs are the growing pains associated with entering an age of abundance. Mm-hmm. So tell me why you're so optimistic, net. I mean, you talked about things are complicated, but net, you're quite optimistic. Tell me why.
I think, yeah. So just unpack that. Like, sometimes you see people talking about it and they're like, oh my gosh, no one wants to work anymore. And you ask them, okay, like, why do you think that? And they say, well, you look out in the world and there's all these for hire signs. But then, a for hire sign says a business wants to hire people. It doesn't necessarily say that people aren't working. And again, you can tell different stories about this, but the number I do focus on mostly is that prime age employment rates. And again, we're seeing that, back to its normal sort of levels, back to the where it was roughly pre-pandemic. And so like people are sort of looking at for hire signs or saying, oh, I ordered this and it hasn't come. Or it's, being backlogged by 2-3 months and saying, well, this is a real problem. But it's actually, it's demand on both sides. It's demand for a lot of imports, a lot of things that, people were not buying pre-pandemic and now are willing to buy. And it's demand for workers that companies are saying, hey, we're anticipating things going to be looking really bright in 2022, hopefully. And so they're trying to sort of get ahead of that. And you see this, not just on the labor market side, but you also see that a little bit in capital investment as well. So it's hard to read. And, a lot of times when you look at these things, and this is the point I make in that blog post, is that, a lot of the ways the American economy has been built the last decade and even longer has been sort of around the assumption that there's a lot of low wage workers or not workers who are willing to work at low wages, workers who are willing to take jobs, whenever they can find them. And we're not seeing that right now. We're seeing that workers have the ability to be a little bit choosier. Again, I want to emphasize some of this is driven by bad things from the pandemic and workers trying to reduce risk. But like, the net of that is that there are increases in wages, that there are sort of, that they do have a little bit more power on labor side versus management's.
So before we look ahead, I want to talk to you about obviously some of the current policy, but let's take a look backwards for a minute. So there's many theories, as you just suggested, for why many workers were reluctant to return to the labor force. Fear of contracting COVID in public-facing jobs like retail and restaurants, the need for mothers to stay home to take care of children who couldn't go to in-person school or daycare, and some say government policy, especially the many cash payments from government in 2020 and early 2021 discouraged work. So do you have a favorite among those theories, or is it all of the above?
Oh gosh, I'll say I have a least favorite. So I think the last one you mentioned about government payments is definitely my least favorite. And I'll say, specifically, unemployment insurance, everything we've done that has sort of a good strategy for figuring this out has sort of said that like this had very, very limited impact in job growth. The best data, I think, is, somewhat ironically, all the states that canceled it over the summer don't actually see people returning to work faster than the states that didn't cancel it. Similarly, when it got canceled at the federal level in early September, it's hard to see anything, with that, but we're not, a lot of people are saying, oh, once that happens, you remove that, you're going to see growth much, much higher. And we just, again, I'm pretty confident about stuff, but trends were basically the same, before and after. So you're not seeing too much of a difference. I think, I think if you force me to pick a favorite, I do think that like a lot of it is reluctance to work in places that have COVID risk. I think that does determine a lot of it, and is sort of changing it. And Aaron Dubé, who's an economist at UMass Amherst, has a theory that's sort of really interesting in that it combines both the bad look I've been pushing out and the good look. But he's saying that, this is, workers often aren't aware of their outside options, that you are in a job, you're earning your wages and stuff like that. And then you're not on the job market. You're not going out there and getting bids and saying, oh, like you'll pay me, $9 an hour, you'll pay me $12 an hour. And one thing that happened in COVID is that a lot of people started saying, well, I don't want to work at this job anymore. And so they started looking at their outside bids and then realized, hey, the outside bids are actually pretty good. And so you're seeing this big reshuffle. I don't want to shortchange like the parents and caretakers thing. I think that's a big issue as well. You can look at the data in different ways. There's not really any good way of looking at the data that really identifies this extremely well. Some people said, hey, it's a big impact. Some people said it's not. I know for me, like I'm lucky enough to be able to work remotely, and every once in a while my child's school closes, and I have to scramble and figure out what we're doing and figuring out how me and my wife and grandparents can sort of manage this. And I'm in this incredibly privileged position where I'm working remotely, where I can take time off, where I have family that's local that can help fill these gaps. And a lot of people just aren't in that position, so that has to be holding them back. And then finally, I do want to emphasize that, if you're talking about like what's going on, it's really important to make sure that people recognize that this is driven primarily by people who are 55 and up, in terms of who's left the labor force, and who hasn't returned, because I think people spent a lot of time in the last decades being like, oh, like what's going on with millennial job participation, and sort of still have that in the back of their mind as the narrative they have. And it's not the case with this one.
So I want to ask you about those older workers. I've seen some data that suggests that they are not filing for Social Security benefits, which seems to imply that they're interested in going back to work. Is that consistent with what you understand, or what?
Yeah. I mean, this is always tricky to sort of think about. And it's something that in the last recession, the 2008 and onwards, a lot of folks left the labor market during the recession, and people are like, well, like they're not coming back, right? And surprisingly enough, in 2017, 2018, 2019, they did start coming back. And so like, this is when you think about this as an economist, like, if wages go up, people will think about it. They'll say, oh, like, and this doesn't mean that it's the only thing that drives it. Plenty of grandparents like hanging out with their children or taking some time off. But if you do have opportunities, you're willing to sort of think about that. And, I would expect that, some people, it'll be stickier than others. Retiring is different than, being unemployed when you're 25, in that you have the option of maybe thinking about long-term. But I do think that, people will, at some levels respond to changes in the market, respond to what's happening. And then finally, like, again, it is a lot of this is COVID risk, and like people saying, well, I'm like, if they can find opportunities for them that do work, either COVID is nearly eliminated or mitigated to the point that people feel comfortable working, I would expect to see people return to that margin too.
Interesting. You talked about COVID risk a lot. Is there any data that tries to correlate people's willingness to return to these public-facing sorts of jobs and vaccine rates or COVID cases in local job markets?
Yeah. I mean, I've done this on my own. This is not something I would like put out as like a publication thing, but like just for my own curiosity, like you can see these rates, you can see a correlation with like things like state level vaccination rates and like return to work and stuff like that. I don't want to, and the reason I haven't like gone put this on like the Niskanen blog is like, I'm like, I don't know. I would not say this is something I'm like, oh, there's a good causal interpretation. Like this is happening because of this. But it does let you say, okay, like something is going on here. I know there's been a couple papers, the names are escaping me right now, that have done stuff like, looking at wage growth within industries versus like mortality risk, right? Because you can see mortality risk differ by occupation. It's very high for meat workers. It's very high for retail and food sales. And there is also a correlation there. So I think there, this both makes sense in terms of like the data has that correlation. It makes sense in that like, yeah, you'd expect people to be less willing to work these jobs. And so I think there's definitely a story there.
Interesting. So it's interesting that you mentioned unemployment benefits, but of course, there's a lot of other things going on, the CARES Act and the American Rescue Plan. There were the economic impact payments, there were the monthly payments and child tax credit. And I think it raises a really interesting question. This is more about inflation, I think, than it is about the labor market. But you could make a case that by giving direct cash support to households and businesses, that this would lead to some inflation, and probably has. But the question is, was the trade-off worth it? Was the need to protect people from financial calamity a year ago worth some inflation today?
Yeah, I mean, I think it absolutely was, and I think that's the right question too. I want to back up a bit because, like, there's some people who you can talk about what's going on in the economy. There's simple stories you can tell about this. There's complicated stories that you can tell about inflation. But I think there at some level, like if the ARP was much smaller, if CARES Act was much smaller, like yes, you'd probably see less inflation, but we'd also be less on our way towards recovery. And the other thing I'll add is like the magnitudes matter here a lot, right? The Economist had a nice chart a few weeks ago, which is saying like, oh, the size of the fiscal stimulus by country versus the inflation rate. And the US has one of the higher inflation rates. But then you look at the size of the stimulus, relationship, and you're like, okay, the high stimulus maybe is 1% of that, right? Countries that had lower amount of stimulus, they had 5% inflation last year versus the US at 6%, things like that. So the margins matter. The other thing that I think is really important here is that, we don't necessarily have the sort of informational capacities as, a government to say like, how do we make sure that everybody is made whole throughout the pandemic? And so what we ended up doing is using a lot of really crude instruments, right? So saying, well, we're going to increase UI payments on a weekly basis by $600 or $300. We're going to give, everyone $1,200, and that's, not what you sort of ideally want to do. Like ideally you want to say like, okay, what would everyone's income be had the pandemic not happened? But we can't do that. We don't know how to do that. We don't know how to measure that. We don't know how to give people that money. And, you think about it like, you could tell the story where, yes, government spending meant that, nominal GDP went a little bit above trend, and that's causing inflation at some level. But like, when I think about that, I'm like, well, there's so many people who really relied on that money, who really needed it to make their rent payments, to keep their kids in school, to buy groceries, anything like that. If you said, oh, well, what if we got rid of this or made these smaller? Like people, you would have had a lot of human suffering caused by that. Whereas it would have been very specifically driven within those people. It would have been those people, get evicted from their homes. Those people have to do, really awful things to make by. And then you say, well, inflation being 1% higher than it would be without it. And again, like it's 6%, but we think, only maybe 1% of it is caused by the ARP. That's, that's painful. That's not great, but it is evenly distributed, throughout the population. So I think it is a trade-off that's worth making.
So let's disaggregate some of these data a little bit. So some sectors are struggling to find workers still, as you suggested. So nursing homes, for example, lost more than 200,000 jobs during the pandemic. Very few people have come back. Healthcare lost over 450,000. What can industries do to fill those slots? Is it a matter of just paying people more? Is it that simple?
I mean, it's not going to hurt, right? Paying people more helps a lot. It's always like the sort of default intervention you do with these things. It's like, okay, how does this transfer paying people more? I think, within sectors, it's going to depend a lot, right? So like, healthcare, there's options, right? So like, again, I think, transmission disease is a big one. I'm sure that hospitals are doing everything they can. Maybe they can be doing more. I don't really know. But I do know that, like, some things that are going on in healthcare were things like, how different state policies sort of matter for the supply of doctors or anything like that. So like one thing that's, very easy to do is saying like, okay, how do you, could states say, well, like, we're going to let people with other, like, who are licensed as medical practitioners in other states, like, perform, come in and get that transferred. Or, like, one thing that was really interesting is that during the pandemic, a lot of places liberalized rules around telehealth. So like allowing you to do doctor's appointments online. And I think some states have started to sort of walk that back, and, maybe now's not the right time to do that. So like, that's healthcare specifically. I think that, each of these sectors is going to have, a slightly different story. And just as, healthcare and other things have had, some things that are holding them back, there's also jobs that have seen fairly robust recoveries. So we were talking about, trade stuff a while ago, and like, you can see, trucking is something that there's a lot of demand for, people doing, and you're seeing this recovery. And my understanding is like, we can't even hire more truckers because we don't have enough 18-wheelers now for them to drive. And so like, I think, looking at those sorts of things, wages is almost certainly a big part of it. Thinking about, what are the barriers to those jobs right now that you can do, and thinking about, what are ways that you can make work conditions more pleasant, both on the sort of COVID level, but also other ones. One last thing I'll mention is like airlines is something that like they've seen really robust growth. And I was seeing, people talking about this, and, one thing is that like airlines are unionized in a way that allows them to make sure that they can say like, oh, here's what work conditions are right now, and here's how we're going to improve them. And so being able to sort of like communicate that and make sure that that's actionable, I think has been really valuable for them.
I want to follow up on one thing you just mentioned is, and I wonder, do you think we're actually seeing a permanent change in the nature of work? Will workers who can demand more workplace flexibility, as you and I can do, will we see structural changes in compensation, especially for low-skilled work? Will we see more robots? Or is this just all transitory, and a year from now we're going to be back to where we were in 2019?
I think that's a policy choice, right? So I think it's transitory if we don't do anything about it. And obviously, like, some things will be permanent. Remote work is not going to go away after everyone spent, a year learning how to use Zoom. But I do think, this sort of pressure on wages, this pressure on employers, that is something that is a product of policy, is a product of both the COVID stuff I mentioned earlier, but also of things like, the supports that the economy has been getting that's, really unique to this recession compared to every other one. And, it's sort of funny, last summer, you'd see people saying like, oh, we're in this bold new age. And like, no, like this is caused by policy. This is caused by, the policy conditions that have, in addition to COVID, been creating tight labor markets and creating this area where wages can demand. Now, obviously, like, you can imagine something where that's enough to knock us into, from one phase to another, that is sustaining. But I think that, this is something that I think people overestimate that effect. I think that people have to be thinking about, how do we keep, these things going into 2022, into 2023, because we do want, we want tight labor markets. We want people to be employed. We want high GDP growth and everything like that.
So some critics of Build Back Better, at least the House version of Build Back Better, say it is inflationary. So let me just ask you on the labor market side, will Build Back Better add to wage pressures?
I mean, it'll depend on the sector, as we saw, like, so some stuff with childcare specifically, like there's sort of mandates and requirements for childcare wages to go up substantially. And again, there's stories you can tell about that, right? There's stories where, you can say, well, this is going to increase these people's wages, make, and make those programs work better? Absolutely. And then there's a story where it's like, okay, that's going to get really expensive, especially for parents and households who aren't going to be getting a lot of the subsidies that are happening through it being a means tested program. So, you can tell that. And then the sort of big picture thing is like, Build Back Better is almost but not quite paid for. I think that's my recollection. I think maybe, there's like $200 billion. I think it's something that I think inflation is probably the wrong way to think about it, right? In that it's going to, it'll be some prices you expect to go up, some prices you expect to go down, but it's not something that is going to be this overwhelming force that, the Federal Reserve or other things won't be able to respond to. And then the other thing is, what they are hoping that it's going to do is, in the same way that the ACA did, is they're trying to say like, okay, how can we, reduce inflationary pressures over time by building up sectors of the economy that would normally be places inflation happened. And the administration is trying to sort of talk that into the short run things, but I think that is much more like, okay, these will reduce things over the long term, over 5-10 years, versus, if Build Back Better is passed, that's going to have very little impact on the first half of 2021's inflation growth.
So perhaps the most far-reaching individual income tax proposal in the American Rescue Plan is the full refundability of the child tax credit. That helped bring millions of children out of poverty. Yet critics say decoupling the credits from work by making them fully refundable will discourage work. Do you think it will?
No, I really don't think it will. There's sort of two things I'll say about this. Is that one, people often have like the wrong concept of how people think about this. So we were talking earlier about like, how do old people decide whether they're going to work or not? And, they say, okay, like I value my leisure and I also value a wage. They sort of look at those trade-offs. And you think about, when you talk about something like a $300 a month tax credit that's going, including to non-workers, that's not going to impact it through that sort of channel. No one's going to say like, oh, I've got enough to live off of right now. This is great. Everything's going to move forward. And similarly, like when we've seen expansions in other countries, and remember, like most countries in the OECD, which, high developed countries, Britain, Canada, things like that, have these programs. And you've often seen when they're introduced, you actually see labor supply go up. That, it means that people are now, earning enough money with this to pay for childcare so they can join the labor market. That said, like, are there some ways that it could, are there going to be some people at that margin? Are there some people who, because you're no longer subsidizing low wage employment, might decide not to do it? Sure, but like I think it's one of those things that at the margin, it's just not going to make a big difference from that sort of labor supply, how many people are working, and we just don't see that empirically in other studies that have done that, or in things like basic income trials that the United States and Canada and other countries have done a lot of.
Yeah, paid family leave, I guess, is another one of these interesting questions. Everybody else does it. We're way behind the curve. Same question: how does it affect labor markets?
Yeah, that's a great question. And it's sort of interesting, right? Because like paid family leave, like, yeah, it's going to stop you working when you're on paid family leave. But the other question is, does it keep you sort of attached to your job? And I think, so like, yes, it'll, maybe reduce how much people are working in a year, but also like increases sort of attachment to the labor force. And the latter is really important, something that the United States is sort of really bad at traditionally, right? Of saying like, once you're unemployed, how do we get you back in? And a lot of other countries have, real big, what are called active labor market programs that sort of reintroduce you to the job market, help you get training and stuff like that. The United States, I think, spends about a fifth what other countries do, like Canada and the UK, on this. So it is something that we just really underinvest in, and that's one of the reasons our labor participation is relatively low compared to other countries. So yeah, and the other thing I'll say, like, when you look at, like, when you talk about like that labor market connection, like leaving the job versus staying on that job, we just had a big experiment with that with the pandemic, because a lot of European countries said, okay, we're just going to pay your payroll. We're going to pay everyone at the company's payroll for the next 6 months or whatever. And, and no one loses their job. The government just pays their payroll. And we did the same thing, but we did it through unemployment. So everyone got disconnected. And again, as exciting and great as our labor market rebound has been, like Canada's has actually been somewhat faster because, they didn't, no one, just that sort of like, oh, you're now unemployed versus, oh, you're on leave waiting for your job to recall you. It does change things. It does mean that that reconnection is harder. So it'll affect those margins. But like, it's not something where you're like, oh, everyone's going to leave the labor market, and maybe some people join it.
Well, we are out of time. Matt, darling, it's been a pleasure talking to you and learning a little bit more about labor markets, which is usually not what I do. So thanks very much for joining us. Thanks to the audience, and I hope everybody has a good day, good weekend. Thank you.
Great. Thanks, Howard.